Well, thanks for tuning into this episode of Navigating Through Uncertainty. It's a short series that we thought it's best timed currently because, from a perspective of an average Indian investor, indeed, if you're a global investor as well, the uncertainty around world markets and not just equities seems to have crept back in because of a multitude of factors, including maybe rising inflation and yields, rising COVID cases for sure, and the markets which have risen to levels wherein the valuation comfort may not be existing for a few investors. So, a battery of special guests in this series, and we kickstart this with none other than Taimur Baig of DBS. He joins in right now to talk about his thoughts. Taimur, so good having you. I hope all is safe.
All good, Kiran. How about you?
Touchwood, I can safely say that everything is good for now. Let's hope the things in India improve soon. But that's my question to you, Taimur. The two big uncertainties, if the uptick in inflation expectations and the upward movement in yields wasn't enough, we now have these rising cases, and not just in India, but a bunch of other parts of the world as well. What is your sense of how do they impact asset classes?
So I think the view on asset classes would be a function of the extent of damage that the resurgence does. But we should also be cognizant of the fact that this is by no means as dire as it was a year ago. A year ago, we knew very little about the disease. We did not have the wherewithal, the protocols associated with the optimal response to those who are affected by it. Now, of course, we were a year away from a vaccine rollout. So now that we have a vaccine, and even if I or you were to go to a hospital, that the hospital has a very well thought out protocol of how to deal with us, makes one have a fairly high degree of confidence that the economic damage from lockdowns, from cessation of economic activity, all those things will be far better dealt with this time. We know how to deal with this disease. We've been living with it for a long time now. So yes, it is worrisome that we are seeing sporadic cases of lockdowns being reinstituted, but they will by no means be as long as the ones that we saw last year. It is worrisome that the variants are creating some degree of headache, and there is some fear that the first generation of the vaccines may not be fully effective against that. But when we say fully effective, they're still hugely effective, may not be 100%. And similarly, there are some concerns here and there you see, particularly in Europe, about some of the side effects associated with one or two vaccines out there. But again, nobody's saying that things from a public health perspective are even remotely comparable to the dire situation a year ago. So when we think about asset classes, we have to sort of keep that as a starting point, that we will not revisit the complete lack of confidence and uncertainty and flight to safety that we saw when the dollar soared and interest rates collapsed, but at the same time, credit spreads widened and there was this huge fear of a global liquidity crunch. That stuff is not coming back. Now we have issues related to, inflation outlook and too much issuance and all that kind of stuff. But just from a basic macro backdrop, I don't think we need to worry that much about equities or bonds being undermined by the pandemic. We can talk about other things, but just from a pandemic perspective, I would not be as concerned.
What concerns you then?
Well, I think the tug of war between the don't worry about inflation camp and worry a lot about the inflation camp, particularly with respect to the US Federal Reserve, where the Fed FOMC members are trying to tell us, don't worry, be happy. We will not touch interest rates in 2021. We will not touch interest rates in 2022. Most likely, we're not going to touch interest rates in 2023. I think that's a tall order for the market to deal with right now, given that there's so much uncertainty, and also around prices. At least if you look the last 6 months of developments, one does not have a great deal of room for comfort that prices will remain benign. At least in the near term, the next 6 to 9 month horizon, prices of rice, soybean, certain semiconductor chips, certain energy products, certain industrial metals, all of those things are heading in only one direction, that is up. We have idiosyncratic supply-demand mismatches. We have a big surge in demand coming from all the stimulus measures. You put them all together, it's hard to see how that can all result in something very, very benign. So I think that tug of war, where if we see the long-term inflation expectation markers If we see long end interest rates themselves, they have ticked up. But at the same time, the central banks are telling us, ignore all that. Everything is transitory. The growth pickup is transitory. The inflation pickup is transitory. 6 months, 9 months from now, they'll go away. So I think that is a potential source of tension. We have a lot of debt in this world, a lot of companies, a lot of countries that will come to the market for refinancing in the next 6 to 9 to 12-month horizon, quantities that we have not seen ever before. So for that refinancing to take place in an orderly manner, you need inflation and interest rates to be under wraps. You also need liquidity to be ample. A sudden spurt of inflation would undermine all of those three dynamics and create debt refinancing related difficulties. So that's probably at the top of my concern right now.
But this spree of companies needing to come up and refinance their debt would be a ever continuous factor. So are you saying that that one of the reasons why you might not, if at all, if the inflation uptick and the interest rate uptick is a bit more benign, then it will cease to be a concern. But if it all happens in a bunched up fashion in 2021, that could pose a problem.
That's right. The issue is 2021 and 2022. So from a medium term debt refinancing perspective, we have a huge bunching of refinancing these 2 years. From China to India to the US, a lot of debt was issued 3 years ago, 4 years ago with a 3-4 year tenor. They're all coming due right now, so they need to be taken care of. Now, when you look at balance sheets of companies around the world, one doesn't have major room for concern because the interest spending as a share of their revenues is actually pretty low. But the fact of the matter is that the volume of the debt is very high. So it's not basically the ratios right now, it's the shock to the ratios. And if we were to see a 50, 60 basis point upside to inflation expectations, and that took the 10-year US Treasury to say 2.3, 2.4, what kind of collateral damage are we going to see? Maybe most companies would be okay, but there could be certain high-profile companies with a great deal of refinancing difficulties, and then you could have contagion and the usual stuff, Niraj, that we have seen many, many times. Developed markets, a little bit of stress. Emerging markets, lots of stress. Sovereigns in the West, even though they are badly behaved in terms of fiscal profligacy, they get away with it. Our sovereigns get in trouble. So that's the sort of stuff that can ensue, even if the spurt in inflation was modest. We're not talking about 5-6 percentage point upside. Just 0.5%, 1% upside could spoil the picture.
Okay, so one more question on this, and I'm just sticking with this for a bit because it's obviously the biggest talking point. The anti-inflation camp talks about how tech-enabled world would largely be deflationary, so to say. Plus, the incomes around the world, except for the UHNIs, has probably not gone up in the whole of the last 12 months for there to be a very large spurt. And I would want to hear your thoughts there. But my principal question is this, Taimur. What quantum of inflation rise would be welcome? Because I hear this argument that a little bit of inflation is actually welcome in the current scenario. And from an equity watcher's perspective, where would it start hurting? Because aside of the refinancing issues, the behavior of the NASDAQ when the first bout of fears of rising yields and inflation came about was evident, right, with the way the NASDAQ sell-off happened. So how would the equity asset classes, and particularly the highly valued companies, react with whatever rise that we see in yields and inflation over the course of the next 9 months?
Right. So let's talk about the first issue, which is the role of technology as a source of deflationary dynamic. Certainly, I mean, in terms of electronics goods over the last 20, 30 years, we have seen an exponential increase in power and capacity and connection speed, but the price has been more or less the same. If you were to take a time machine and went back to 2001 and went to Dell.com, a Dell PC of those days with a 486 processor probably would have cost $1,400. Chances are the top of the line Dell PC today would be that, if not cheaper. And similarly, Apple products, which are always at a premium, used to sell for $2,000. They sell for $2,000 now, and 20 years have gone by. So the competition, the producer surplus that gets eroded by the competition, and the consumers end up getting the surplus. I mean, that has been a very welcome feature of the tech revolution of the electronic space over the last 20, 30 years, and we have all benefited from that tremendously. Now, the outlook in the near term, however, is that we around this pandemic we have sort of seen spurts of demand for certain products, and also this whole phenomenon of Internet of Things has led to a huge surge in demand for wide variety of chips, production of which is not keeping up. And since consumers have power to or desire to buy these products, and the suppliers don't have sufficient quantities, I think it's a meaning of the two that sort of suggests that we will see the price of, say, a DRAM or any other chip going up, and if those component prices go up, the price of the iPad, price of the iPhone could well also start going up. So this is issue number one, that in the past, technology has played a great role, but there's a second issue, and they're interrelated, which is that all the technology-driven disinflation took place at a time when globally union power, minimum wages were all at a very weak footing. So therefore, the wage bargaining power of the labor class was at its bottom. So we were believers in big free trade agreements. We believed in comparative advantage, but we didn't worry too much about taking care of the people who would be sort of left behind in this huge transformation and what would happen to their purchasing capacity. Now, for better or for worse, I think this pandemic has galvanized that point to the extent that we are seeing companies going ahead and raising wages of the very bottom earners of their payroll, and countries like the US are talking about significantly higher minimum wage. So if you start seeing wage growth picking up, and my view is that in the near term we will see wage growth picking up, and if that starts to outpace productivity, then I think one can say we have the recipe for inflation right there. I think the anti-inflation camp would say labor markets are still pretty soft, bargaining power is still pretty weak, wages are not going to pick up. We shall see.
Yeah, we shall see. What about the other aspect, that what does it do to multiples, if nothing else? Let's assume it's not too disruptive in the borrowing cost feature, but what about the multiples argument and the fact that NASDAQ and tech companies and some of the others are trading where they are, and a higher inflation and a higher yield and therefore a higher discounting factor might hit them? Do you reckon that would happen, or do you believe that one more year of earnings behind them will kind of take care of some of these issues and the collateral damage, if at all, to EM equities?
Let's consider this from a sort of very standard equity valuation model. Okay, so you take the Case-Shiller price earnings ratio, you invert it, you get the E over P, which is the equity yield. Case-Shiller price earnings ratio for S&P 500 is basically at the same level now as it was during right before the Great Depression bubble, or before the 2001 dot-com bubble. So markets are very expensive, and if you invert it, you get an equity yield of, say, 3% or 3.5% or so, which is pretty good when long-term interest rates are below 1. It's not that great when long-term interest rates are heading toward 2. So that's what I meant by, you don't need a lot of change because the yields are modest. But till a few months ago, we were basically talking about very flat yield curve and short-term rates staying at 0 for at least 3-4 years. Then even that fairly modest yield coming from the equity market looked extremely competitive relative to virtually nothing one was getting from the fixed income market. That dynamic is changing by the day. So now the fact that the US yield curve has steepened by more than 150 basis points, all of a sudden the difference between the equity yield and the risk-free rate looks not that great. So from a standard equity valuation model, or from a standard portfolio allocation model, you'll now say, well, I probably need to reduce weight on equities simply because the relative valuations are altering, and it's altered quite markedly in the span of just 3 months. So you may have a fairly benign view about inflation, you may have a fairly benign view about interest rates, but already the movement so far itself will give you some signals to reduce weight. So that could be, in my view, the first step towards some degree of consolidation in the equity market. A crash is going to require seismic events, a huge setback on COVID, a huge setback on inflation, or massive geopolitical tension. I would like to think that any of those three things are relatively unlikely in the horizon, and therefore sort of the trigger for crash, at least on the macro side, is not there. You can also have crash stemming from fraud or a systemic crash of certain product, like the way we saw with mortgage-backed securities 13 years ago. I have no ability to predict that. But if you put that aside and just look at the macro drivers, yes, leverage is high, rates are low. So you would now need a dramatic change in the rates outlook for the entire leverage, expensive equity valuation edifice to collapse, I think it's more likely that people get more defensive as opposed to they forsake the equity markets.
Yeah, well, a ship created a flutter a couple of weeks ago when it came to markets, so you never know.
Indeed.
Yeah, but just one quick follow-up, Taimur, before I come to EMs in India as well, and purely on the equities side. But just one quick question. So, am I understanding you correctly that you believe, or what you're saying is that under the current circumstances, if interest rates were to stay where they are, yields were to stay where they are, I'm using the two interchangeably, or if they were to move up on the US side, maybe 20, 30 basis points higher from where they are right now, that is not a recipe for disaster. But if they cross the 1.75 and go up to 2 and 2.25, 2.5, that to your mind, even if it is a known, has the potential to bring down equities.
Yes. So it's the pace with which we go from here to there. That's the issue. I mean, if I and you were to say we take a time machine, but this time we go forward 2 years and 10-year interest rates is 2.5, 2.6. Great. I mean, the Fed did an amazing job of reflating the economy. Growth is good. But if we say that's going to happen in the next 3 months, oh boy, we're going to have some issues in the markets.
And 2021, 2.25, 2.5, would that worry you, or would you believe that's kind of discounted?
I think if we were to travel to 2.25, 2.5 gradually over the course of 3 quarters, because growth forecasts are being revised upward, inflation forecasts are being revised upward gradually, no problem at all. I think the global economy can handle that.
One more question on the global front, and which is this whole debate around real economy and value versus what's traditionally worked for so many, not traditionally worked, but what's worked for the last 2-3 years or maybe longer, maybe the decade. And where do you believe the near, I mean, the decade out is too long to predict, but do you reckon that a rising economy would probably get investors more interested in the real economy stocks, which probably had better valuations world over, versus tech, etc., all of which are premium valuations and have really enjoyed the fruits of investor interest thus far?
Right. So, it's easy for me to say that tech stocks are overvalued and people should be defensive about them. But look at the story that the tech stocks have presented to the world over the last 2 decades. I mean, they have been absolutely transformational. We were just talking about Elon Musk and Tesla the other day, that Musk is a bit of a maverick and goes out and says what we think are sort of crazy things once in a while. But if you look at his interviews from 10 years ago and see his vision and how much of that vision has actually come to fruition, it is just jaw-dropping. So clearly, I mean, you and I can both look at Tesla's balance sheet and say, the stock price makes no sense. I mean, it is priced for perfection for the next 20 years, and even then, maybe it will not be good enough for the shareholders, right? But at the same time, how can you deny the amazing technologies, the game-changing developments that has come under the aegis of that company? Similarly, I mean, one can make arguments like that for a wide variety of tech companies where questions about valuations are always there. But the fact of the matter is they are making people's lives better and they are delivering products that we like to consume all over the world. So I think that this tech versus, or rather growth versus valuation debate is a reasonable one. Again, from a portfolio manager's perspective, you are interested in dividend yield when fixed income yield is anemic, and therefore you then sort of looking at dividend yielding stock itself as a value proposition over a growth stock or a safe asset like a US Treasury bond. So from that perspective, what we're seeing right now, and we've seen this false dawn, if you will, several times in the last 6 to 9 months. Every time the normalization narrative comes in, the ship companies and the tourism companies and the mall companies, they're all rallying because here we go, things are going to get normal. We're all going to go back to these places and the growth to value rotation is going to happen. And then it sort of falls apart because COVID doesn't go away, or maybe because we're sort of second guessing how much normal the world would be even when everybody's vaccinated. So I have some degree of attractiveness toward companies that have good cash flow and can produce steady dividends. And they're in any portfolio, I think there is a very important role to be played for stocks like that. And thankfully, even today, when one looks at, for example, ETFs that are based around high dividend paying stocks in the S&P 500, they yield close to 3%. That's great. And I again think that they have a very strong room in people's portfolio. And by the way, those ETFs are rallying. So if one wants to get in, time is now, or maybe almost too late. You'll then have to deal with like 2% dividend yield as opposed to 3% dividend yield. So bottom line, it's not either or. The rotation may happen, but in a portfolio, there is room for high flying growth stocks and solid dividend yielding value stocks.
Okay, now let's focus a bit on EMs in India. And 2-3% viewers, I know for an Indian investor would sound like, really? Do people invest in such stuff? But let's talk about that. Taimur, the narrative around January and February was largely around how the China, or maybe slightly earlier than that also, was that once normalcy returns, the China plus one narrative alone would benefit a lot of these Southeast Asian nations. And it has, because a lot of supply conversations that we get from companies is that companies or multinationals which hitherto only source from China are diversifying. Even Indian companies are getting some share of that, even though it may not be the lion's share. But I'm talking about the region at large. So that was the narrative. It has partially been hit by rising cases in Philippines, in India, and some of the other places. What's your sense? I mean, you started off the interaction saying that you don't believe that the second wave or the third wave, as countries may like to call, the second wave or the third wave will not really hit economy and thereby maybe businesses that hard. So do you reckon that weaknesses, if any, that come in because of this reason, partially, could actually be buying opportunities because the liquidity safety net is alive and kicking?
Yeah, I think so. Look, I think we can say very safely that if today there was a big order coming in from, say, a Western company to produce iPhones, or a huge order from like an H&M or something for garments, I think the owner of that manufacturing plant, whether it is in Philippines or in India or Indonesia, they know the protocol to follow, that even if there's a COVID resurgence taking place, how to keep that manufacturing plant going. This is the big difference between today and then. We were shutting everything down at that point. We're not going to shut everything down. We know how to carry out agriculture. We know how to carry out manufacturing, even if everybody's not vaccinated, even if there is a big surge of virus taking place. So which is why I think that this fear that around a resurgence in COVID virus, and that is of course happening, there's no denying that we'll sort of head back into the kinds of lockdowns we saw earlier, it's unlikely. And therefore, if indeed the markets are getting nervous and they are getting worried about the outlook, which is justifiable, but it would then certainly open up some stream of value, in my view, from the sell-off, because I cannot see any of these developments being sustainable. We are winning the battle against COVID. We are vaccinating the world, maybe a little slower than we would have wanted, and certainly the variants are complicating the matter. But even a century ago, the 1819 pandemic, it went away at one point. There was a herd immunity, and it did go away. It seems like we're in the middle of a nightmare that'll never end. A year from now, when you and I talk, we'll talk about very different things.
Well, touch wood, inshallah. Hope everything works out that way. Okay. What's your view on India sitting from the perch that you are at, wherein you get a chance to look at various other geographies, various other economies, and then try and map India out there? Because what we did not get in the whole of 2020 was a large stimulus, but hey, it eventually turned out to be okay, maybe. But the government, to its credit, has done some amazing stuff with tax rates all the last 2 years, the PLI schemes that have been announced left, right, center, and what was being hailed as a really good budget, almost unheard of in the last so many years. So post all of this, but amidst this scare around the rising virus and the lack of stimulus, where does India stand vis-a-vis some of the other countries that are vying for capital? And how would you rate the markets currently with for somebody who's looking at it not just 6 months out, but maybe 18, 24 months out?
So India always commands a great deal of goodwill from global investors, even though returns have not sort of, kept up with that sort of, expectation. 5 years ago, 10 years ago, if you were to put in 10,000 market in the Sensex index, after adjusting for the rupee's depreciation, the returns are not great. You would have been much better off investing in S&P 500 than Sensex. Now, sitting in India, when you're looking at the rupee returns, it looks pretty good. And there are certain Indian companies that have actually outpaced the exchange rate movement, have delivered very good returns, even for foreign investors. You think about like an HDFC Bank, this ADR has been a star source of return over the last 5-7 years in the US. But by and large, I think the goodwill has stayed despite underwhelming return from the broad indices. And the investors clutch onto every positive news out of India and are generous enough to discount most of the negative news. Now, if you have years of paralysis on policy or years of uncertainty about tax regime, of course that hurts investor sentiment, and it then manifests in people's misgivings, both in the capital markets as well as direct investment spaces. That's inevitable. But right now, we are looking at investors who are in general favorably predisposed toward India, and they're looking at manufacturing sector as a possible source of significant long-term growth. Going back to your narrative that if countries are thinking about China plus one, which countries can offer the scale that can even partially mimic what China has to offer? I'm certainly Vietnam and India would be top of that list within Asia. So we do hear from Japanese companies and Korean companies and Taiwanese companies a lot of medium and long-term plans about setting up manufacturing in India. They are hoping that the local governments and the center would be good partners in going for that, because these things are capital intensive and labor intensive and require a long gestational period during which you need policy certainty, you need availability of labor and land and infrastructure. So all of those things are hard. It's far more than passing a law. That's ground level delivery reality. But it can be done. We have seen East Asia do it for decades. It's India's turn now. And to sort of sum up that point, investors are looking at it favorably. They are hoping that this is the turn.
Do you sense you looked at policy for a number of years, right? I mean, in India specifically, do you sense that this time around is really different? I mean, I'm just using the budget and the PLI schemes as an example of the government finally waking up to the fact that let's treat business as the highest priority, because that will do everything else. If economic growth comes in, all the other pains would be forgiven.
Yes, I think that we need to first take stock of the existing reality, which is a tough one. That it's not just COVID. Remember, we came into this crisis already on a weak footing. The banking system was dysfunctional. Yeah. Growth was anemic already. So when we sort of start picking up the pieces from the slowdown and the loss of GDP of the last 1.5 years, well into 2022 or not 2023, before all that lost ground is being made up for, and going back to the trend that was seen in the middle part of last decade, that'll take maybe another 5 years to go back, right? So it's a daunting task ahead. And it is coming at a time when you have to have very progressive forward-looking thinking, because the world is not static. It's changing very dramatically. The trade regime, the way capital is moving around the world, the outsized role of China, everything has to be sort of considered on a dynamic basis. So I do think that the current policy package seems to be cognizant of those major changes that are taking place. India is trying to seize on the opportunity of the evolving global manufacturing landscape. India is cognizant of the fact that in the China-US tussle, there are certain angles that India can pursue, which can act to its benefit. And I think that is, again, also being pursued. So the economic aspect, the geopolitical aspect are almost intertwined these days. You can't really separate the two. So India is certainly on the right side with respect to galvanizing global interest, and its policy signals are certainly being constructive or being seen as constructive.
Okay. So Taimur, before we wrap up, I mean, you've given us a fairly decent view of how the top-down or the bird's eye view is. Just one more aspect. I mean, just looking at the way things are evolving within India. The RBI has been at the forefront of fighting the battle when it comes to almost everything. Really, they've done the heavy lifting of sorts. We just did a policy on Wednesday as well, when the dovish stance seems to have been extended thus far for the foreseeable future. How do you see the bottom-up story in India? Do you reckon that earnings growth would come back partially because of the low bases, but also because of the efforts that the government has put in? too, corporate India has deleveraged heavily over the last 3-4 years during tough times, and maybe that also aids the performance over the course of the next few. Any thoughts on the bottom up picture in India?
So my worry is not about the corporate balance sheet. I agree with you that there has been significant amount of deleveraging, and the sort of excessive investment boom bust that we have seen in the last 20 years, particularly around the construction property sector, I think is in far better footing now than it has been in a long, long time. I worry a bit about household balance sheet. India has never been a country where households are highly indebted, but debt has gone up, and it hasn't held up well against the macro headwinds of recent years. So it is in the interest of households, in the interest of the consumption outlook, that RBI succeeds in keeping inflation down, succeeds in keeping interest rates down. I mean, mind you, the last 1 year has not been great in terms of inflation outturn. Market has been forgiving, global markets. I mean, nobody really cares if supply side related disruptions are putting your inflation up to 6.5%. This is not a time to get all very holy about the inflation outlook. I think the RBI has struck the right tone that the focus is on growth, not on inflation right now, because some of these upsides, there's nothing monetary policy can do anything about it. So going back to the issue of the ground reality and the outlook from the bottom up perspective, consumption ought to be well supported by the fact that interest rates are low and job creation will resume on the back of manufacturing resumption and some degree of normalization of the economy in the second half of this year. As India gets into this whole supply chain business where Indian companies or foreign companies operating in India start making components that will then make a finished product using various other components produced in various other parts of Asia, India then becomes part of this whole supply chain. And the positive spillover, whether it is technology transfer, know-how, corporate culture, and the safety that comes from being part of a bigger manufacturing community, I think could be immense. So I think that corporate India, by virtue of having a leaner balance sheet and this tantalizing prospect of a manufacturing rebound, is in good shape. We need to keep an eye on the households.
Okay, Taimur Baig, this was really nice of you to join us and give us this whole sense around how the world is looking currently. But actually, Taimur, sorry, before we wrap up, how can I not ask you? Sorry. I can't let you go without talking about the other big fascination that the world has currently, crypto. We talked about equities, we talked about other asset classes. Hey, what about crypto? I mean, it's fast emerging as an alternate to almost everything. Any thoughts here?
There are so many things going on in that space right now that there's no way I can do justice to that, because you see, I mean, these days I don't even write about digital currencies. I write about digital assets, because from NFTs to DeFi, there are all sorts of things happening. Basically, just one simple point: the way to organize creative content and to carry out transaction is being fundamentally upended by this whole digital asset, digital currency revolution. That you can create assets that are virtual, but you can also take assets that are real and create a perfect trail of provenance and transaction in a transparent manner that can solve a wide range of problems that exist, particularly in the developing world, with respect to property rights, with respect to movement of goods, with respect to trade credit. So it's not just about punting on Bitcoin and whether it goes to $100,000 or $10. It's about something that is far beyond that, which is that a blockchain-based or a digital-based transaction record keeping, provenance tracking, to what extent it can add efficiency to a lot of things that are almost as old as time. Wow. Trade finance, ownership of goods, these things have been tracked, and it affects people and legal minds over the centuries, across millennia, across continents. So this is what I'm really excited about, that we may have tech-driven solutions to some of these age-old problems, and that can be very good for the world.
Yeah, money transfer, for example, such a big thing. But yeah, I just trying to understand, Taimur. Sorry, I'm extending this conversation for just a wee bit longer. But so one is what crypto can do, and or rather what blockchain can do. Let me rephrase myself, to a variety of spaces, and which is profound and which is great for the average low invest or user as well. But from an investor's perspective, what happens? I mean, whether or not India goes ahead and puts what kind of curbs is one thing, but independent of that, do you reckon that there is merit in trying to study and understand which of these digital assets could really do well? Because I'll tell you why. For the uninitiated mind, the comment that sticks is that, hey, look at these, they've done well in the past and then come off. Look at some of the other examples, look at various other past historical references being done to booms and busts, and everybody correlates crypto or digital assets to that. Do you believe that could be a possibility, or do you reckon that this is actually different if studied well?
I think from the Dutch tulips to the South Sea oil bubble to crypto, many things, can be subject to panics and manias and bubbles. That doesn't mean that the underlying story is useless. Tulip is a pretty flower. Even today we trade them, but the bubble was, it had very negative collateral damage. So similarly, I think that the use case for a digital infrastructure around the blockchain is massive and tantalizing. Whether it's a central bank that wants to find smarter, faster, more efficient ways of distributing cash to the population, to say a central bank like the Central Bank of Cambodia, which wants to find a solution for all its migrant workers in Thailand and elsewhere to send money back home. And they are actually attaching themselves to a blockchain to allow their currency to be used for money transfer. I think that there's tremendous potential, which is why I was sort of keen to steer the conversation away from digital currency, which is what people sort of associate with this whole space, which is crypto, which is a private digital currency. In my mind, what is happening on the public side, the central bank digital currency, whether it is in China or in the US, and what is happening on the digital asset side are far bigger stories of our time than just a cryptocurrency would be. Cryptocurrency right now is kind of popular because people who are nervous about the money printing, people worry about debasing of the reserve currencies of the world, and they feel that if there is a currency out there that by algorithm restricts the number of units out there, it's probably safer and probably gain value. And there are some serious people, including our friend Elon Musk, who's a believer in that. So can't really dismiss that view entirely. I think that this notion that on one hand you have huge explosion of M2 in certain parts of the world, and by definition you cannot have a huge binge in money expansion on a currency like Bitcoin. I think it's a compelling apples oranges contrast, that they're very different. But it's not a currency per se. I mean, to me, currency is something that has a huge amount of use case. The infrastructure of Bitcoin and blockchain is such that the computational intensity associated with day-to-day transactions just doesn't make any sense. That's why I'm far more compelled by the usability of a central bank digital currency as opposed to a private digital currency that is hugely reliant on the blockchain. That sounds a bit inefficient to me.
Yeah. Well, but this is nice. Taimur, thank you so much for joining us today and help us navigate through some of the pieces which will help everybody who's listening to this during the slightly uncertain period ahead. Much appreciate your time.
Thank you very much. Take care.
And viewers, thanks for tuning into this episode of Navigating Through Uncertainty.